Welcome back to The Explainer. So glad you're here with us today. Look, if you follow the financial markets at all, you know that the insurance tech sector is just one of the most hotly debated spaces out there right now. And sitting right at the dead center of that debate, Lemonade. So today, we're throwing out the opinions, we're completely ignoring the hype, and we are running a strict, objective financial diagnostic on Lemonade, using absolutely nothing but the raw data. We're going to look under the hood to see exactly what's making this company tick, where it's bleeding, and how the market is actually pricing it today.
Okay, let's dive into this. Just look at that number, 127.4%. If you held Lemonade stock through all of 2024, that was your return. I mean, it's the kind of massive triple-digit gain that absolutely dominates headlines and brings a total flood of momentum traders rushing into a stock. But as we know when we're running a financial diagnostic, a single symptom never tells you the whole story of the patient, right? To figure out what this huge number actually means in the grand scheme of things, we really need a roadmap for the rest of our analysis.
So, here is our diagnostic roadmap for today. First, we'll look at the stock's roller coaster history. Then we'll check its surging top-line revenue. Third, we'll diagnose the underlying profitability problem, then evaluate how to actually value it, and finally, we'll wrap up with our final financial verdict. Section 1. The Lemonade Stock Roller Coaster. We're looking at a history of massive swings.
Honestly, Lemonade's stock history reads like a financial thriller. Back in 2021, the stock was just heavily punished, dropping over 65%. And then the market hammered it again in 2022 with another brutal 67% drop. If you happened to buy in near the peak, those years were literally devastating. But then, look at this reversal. We see a modest 17.9% stabilization in 2023, which was then followed by that explosive 127% surge we just talked about in 2024, and then another massive 94% jump in 2025. But wait, as of year-to-date 2026, we're already seeing a nearly 28% pullback. I mean, this is the textbook definition of extreme volatility. The market is just constantly, completely repricing this company's future. So why is that? Well, to answer that, we have to look at the business itself.
Moving to Section 2, surging top-line revenue. This is really the heartbeat of the company. In the trailing 12 months, Lemonade brought in $844.7 million in revenue. That is just a staggering amount of money flowing right into the top of the funnel. You know, regardless of what the stock price is doing on any random Tuesday, the fundamental truth here is that customers are buying what Lemonade is selling. They are successfully capturing real market share in the insurance space. But of course, a single massive number is really just a snapshot in time. We need to see the actual trajectory. And this brilliantly illustrates exactly what growth investors love. Over a 3-year period, Lemonade has grown its revenue by practically 40% a year, and over a 5-year period, nearly 56% a year. Sustaining that level of top-line growth for half a decade is incredibly difficult to pull off. It tells us, for sure, that their core product and their marketing engine are highly, highly effective. This surging revenue right here is exactly why the stock sees those massive triple-digit spikes.
Section 3, the profitability problem. Now we have to diagnose the underlying condition. So here is the central tension of Lemonade's entire business model. On one side, you have that beautiful, massive $844.7 million revenue engine we just looked at. But on the other side, a trailing 12-month net income of negative $138.9 million. Yeah, they are generating massive sales, but it is costing them an absolute fortune to do it. The cost of claims, the customer acquisition costs, the daily operational expenses, they are entirely swallowing up all of that revenue.
To put that into some concrete perspective for you, just look at their net profit margin. It currently sits at negative 27.62%. Impartially speaking, this simply means that right now, for every single dollar Lemonade brings in the door, they are losing roughly 27.5 cents. They're essentially paying out of pocket for their own growth. Now, in a low interest rate environment, the market will often forgive this kind of thing. But when the market gets fearful, margins like this are exactly why a stock can plummet 65% in a single year. And this all builds into a broader picture of their financial health. The return on assets and return on equity are both heavily negative, at negative 7.14% and negative 26.81% respectively. This really just confirms the profitability issue we just talked about. Their current assets and their equity are just not generating positive returns. But, and this is absolutely crucial, their debt-to-equity ratio is surprisingly low at just 0.35. This is a very important vital sign. It means that despite the heavy operational losses, Lemonade is not dangerously over-leveraged with debt. They aren't borrowing heavily from the bank just to keep the lights on, which actually gives them a really vital runway to try and fix those negative margins over time.
Section 4. How to value Lemonade. So what's the prognosis here?
Well, if you try to use standard valuation tools on a company like this, they just immediately break. The most common metric in finance is the PE ratio, or price to earnings. Lemonade's is negative 27.46. And because the earnings part of that equation is a negative number, the whole ratio just becomes entirely useless. We literally can't value them based on profits because, well, there are no profits yet. Because of that, for high-growth, unprofitable tech companies, we have to pivot our diagnostic tools. Instead of looking at earnings, we need to look at how much the market is willing to pay for every dollar of their sales. So we shift our focus to metrics like price to sales and enterprise value to sales. Now, what's really interesting about this slide is that when we compare their current valuations to their history, a slightly different picture emerges. Lemonade's price to sales ratio right now is 4.72, and its EV to sales is 4.93. Now, on their own, those numbers indicate you are paying roughly $5 for every $1 of sales they make. But look at the numbers in the parentheses. Both of these metrics are actually down compared to their own 3-year averages. The PS ratio is down 6.6%, and EV to sales is down nearly 9%, which means that, based purely on sales, the stock is technically trading at a slight discount to how the market usually prices it. But hey, valuation is never just a one-dimensional thing. While their sales might be priced at a slight historic discount, look at their price-to-book ratio, which compares the stock price to the actual net assets of the company. The current PB ratio is 7.61. That is actually up over 19% compared to its 3-year average of 6.38. So the market is pricing their sales a little cheaper, but pricing their underlying assets at a distinct premium. It's a really complex, mixed valuation picture that just perfectly reflects this ongoing tug of war between the bulls and the bears. Section 5, the final financial verdict. Let's synthesize all of this data. First up, the reality of the returns. This timeline absolutely proves that Lemonade is not a buy and hold blindly type of stock. It's the kind of stock where your reality is dictated entirely by your specific entry point. Look at the 5-year snapshot, down over 29%. If you've been in it for the long haul since the absolute peak, you're still underwater. But what if you bought in exactly 3 years ago? You're up a phenomenal 239%. And over the trailing 12 months, you're up a very healthy 64%. It's a textbook high beta stock, swinging wildly in both directions. So the crucial point comes down to this reality check right here. We know they are deeply unprofitable on a strict accounting basis, right? With an earnings yield of negative 3.49%. But simultaneously, their free cash flow yield is actually positive 0.49%. That is a massive, massive distinction. It means that after all the cash comes in and all the cash goes out to pay for capital expenditures, there's actually a tiny positive trickle of real cash flow left over at the end of the day. They might be reporting accounting losses, but their actual cash pile is no longer shrinking. And that brings us to the ultimate question for Lemonade, and honestly for almost any high-growth tech stock out there. Can this massive 50% year-over-year surging revenue eventually outpace those deep negative profit margins? If that revenue engine just keeps running and they can manage to just slightly improve their claims and operational costs, this business becomes an absolute cash-printing machine. But if the margins stay negative as they continue to scale, well, the math simply won't hold up forever. That is the fundamental dilemma the raw data leaves us with today. It's a truly fascinating company to watch. I hope this explainer gave you a really solid framework to understand what's actually happening under the hood. Keep learning, stay focused, and I will see you on the next deep dive.